And we are good. We are on. We are live. We are good. So welcome everyone to this Wednesday's Strategic Partner Education Moment Series. Thank you so much for joining us every second Wednesday as we bring you some new strategic partners to support your business as well as improve your clients' business or daily lives as well. Today we're fortunate enough to be joined by Meaghan Hamel, CPA of Hamel Professional Corporation, and she's going to be talking to you guys about the difference between being a sole proprietor and a corporation for your commissions, expense structure, all that stuff. See what makes the most sense for you and what your goals are and kind of go from there. So Meaghan, I'm going to pass it on over to you. So the screen is yours. Do your thing.
Great. Hello, everyone, and thank you for joining us today. The first thing I'm going to do here is set up a screen share, and you should all be able to see my presentation. Alex, if you want to give me a thumbs up if it's good.
Thumbs up.
We will get going then. So as Alex mentioned, my name is Meaghan, and I'm a senior manager here at George A. Hamel Professional Corporation CPAs in Sherwood Park. And I'd like to thank you for taking the time to join me this morning for our discussion on running your real estate business as either a sole proprietor or an incorporated entity. So first off, I thought I'd give a quick little plan for today. Often when I meet with a client at the start of their business journey, one of the first questions they ask me is, how should I set this up? This is usually followed by a comment similar, which I'm sure you've all heard, which is, my friend told me that I should incorporate because, and you can insert that random fact here, such as I'll pay less taxes, I won't pay any taxes, and my favorite, no one can sue me. Well, this may be a legitimate concern to some people. There are some other considerations that we should look into before we make this decision. So with this presentation today, my goal is to put some truth behind some of the myths you may have heard about incorporating, so that when the time comes, you can make the proper decision for your business. And if you've already gone ahead and made that decision in one capacity or the other, then I hope today's presentation can spark some new ideas for you in the setup and how you're running your own business. Okay. So first off, who are we? I always like to know a little bit about the presenter speaking to me so I can understand a little bit of what they have to offer and how I should take their advice. So our firm, Hamel Professional, has been operating in Sherwood Park since 2001. Myself, I have been working in the field of public accounting for the past 11 years and received my CPA-CA designation in 2015. Although I can assist businesses at any stage, I have also taken a 3 years equivalent of a master's in tax law, which allows me to provide some really in-depth tax advice to businesses during their life cycle, which I find to be a real benefit to my clients. Okay. And in a past job, I also worked in recruitment for the University of Alberta. At that time, I was actually taught that you should never fill a slide with text, and if you do, the worst thing that you can do is actually read the text off of that slide. Unfortunately for you guys today, I'm an accountant. I am no longer a recruiter. So I'm going to apologize as some of my slides today are going to be a little text heavy. And while I'm not going to walk you through the services we provide, I do like to throw this slide up there to give you one last thought as to everything that we can do. And before I get too far into our presentation today, I do have to give our quick little disclaimer. So I wanted to take a moment to note that we are accountants and not lawyers. As such, I am not authorized to provide legal advice. As a result, this presentation will be largely silent on any of the legal implications of the two structures. The information that I'm presenting today is also based on current income tax laws. And if the past year has taught us anything, is that those could change at any time. For instance, one of the big laws that we are watching and expecting is changes to the EI program. So if you didn't know those were coming, surprise. So before implementing any of the advice contained in this presentation today, I strongly advise you to reach out to our firm for advice on how to apply these strategies to your current situation. And while I'm more than happy to take questions at the end of today's presentation, as Alex mentioned, I don't want anyone to be releasing too much personal information about their business live on the internet. So if it sounds like things are getting a little too personal about your business, I would do ask that we follow up in private after the fact. And so with that said, let's get on with the show. As a realtor, you know that you're running your own business. In the province of Alberta, that means that you have a few different options for how you want this to look. Today, I'm going to walk you through two of the options available to you as a real estate agent: operating your business as a sole proprietor, or as otherwise known as a self-employed individual, or as a corporation. Often when individuals think of these two types of structures, they immediately assume that their business is not big enough to incorporate, either because they deem it to be too small, and my favorite is that they deem that they are not yet making enough money and it's just not worth it. And while the size and financial viability of your business are two factors to take into consideration when making this decision, there are other items, financial and otherwise, that I want to make sure that you are considering before you make your final decision. Right. So first, I'd like to take a moment to talk about the main differences between the two structures. As a sole proprietor or self-employed, you and your business are one and the same for legal and income tax purposes. While you may have assets that you use personally and assets that you use in the business, there's minimal distinction between the two. A good example is many of you will bring your iPad out to show clients a walkthrough of a home before you head out. Or I guess back in the good old days when we could actually see people, you may have done that. You may then come home and use that iPad to stream Netflix. Minimal distinction between what is a business asset and what is personal. On the other hand, if you choose to incorporate, a lawyer or other authorized agent can assist you in creating that legal corporation and subscribing for shares. This will make you a shareholder. Once you are incorporated, with the help of your accountant, we will transfer all of the business assets into the corporation. So that iPad, it's now part of the corporation and you're really not going to be watching much Netflix on it anymore. This will create a distinct separation between your personal assets and those of the business. Often, it's from this distinction that I hear the comment from business owners that this is how they get out of anyone being able to sue them. Unfortunately, dependent on how your corporation is set up, this may not always be the case. An example of this is as a shareholder, you may also be set up as a director of the corporation, and the director will always hold some liability for some of the debts. And if you enter into any loans or other forms of indebtedness on behalf of the corporation, your bank or other loan lender may also ask you to provide a personal guarantee. And those two events can really reduce your ability to get out of liability. But when you set the corporation up properly with the help of people like myself, an accountant, and your lawyer, we can really help reduce that liability for you so that you can get what you want out of the corporation. Another couple of important distinctions between the two legal forms is how income taxes work and whether or not financial statements are required. So as a sole proprietor, you will file your income taxes as part of, and this is big, long, rambling name, the Statement of Business or Professional Activities, Schedule 2125 on your personal income tax return. By virtue of you being self-employed, you may have until June 15th to file your personal return, dependent on your personal situation. However, any taxes owing will always be due by April 30th. Unless, of course, we're in a pandemic and the government changes every single deadline on us. As a corporation, you will be required to file a separate corporate tax return. Normally, this would be due no later than 6 months after your corporate year end, provided that your business is eligible for the small business deduction, which we'll talk about a little later. The actual due date for your income tax balance also varies, dependent on the type of tax that you have owing. However, the majority of businesses eligible for this deduction will have the balance of their taxes owing 3 months after year end. So an example of this is if you have a December year end, usually your taxes are not owing until at least March 31st. This is an important distinction because when you incorporate in that first year and that first year only, you can actually choose when you want the year end of your business to be. It does not have to be December 31st. By choosing a non-calendar year end, this can allow you to effectively move the date that your GST balance and your income taxes are owing to a time of year when you typically have stronger cash flow. Often the spring market's pretty hot for you guys, which means that you're going to be seeing a lot of cash coming in July and August. You may want to choose a June year end so that your taxes are not due until September when you have a bit more cash flow. Under both scenarios, you're going to add up your income and deduct your business expenses, and this will bring you to the net income of the business, which is what is going to be subject to tax. How this net income is taxed is going to differ between the two legal forms of your business. If you're self-employed, all of your net income is included on your personal return and taxed as though you have received 100% of that money in your pocket. If you are earning income from other areas of employment, so perhaps a part-time job or some interest, that self-employment income that you earn from your real estate business may be added to this other income, which will effectively increase the amount you've earned and increase your personal tax rate, meaning more taxes. As a corporate shareholder, things are set up a little differently. All of the net income in your corporation will be taxed at a much lower rate, assuming that you're eligible for the small business deduction on your first $500,000 of net income. In Alberta, this would be taxed at the combined federal and Alberta small business rate of 9%, which is a great deal. Out of this tax paid income, you will still need to pay yourself, which we will discuss the income tax implications of on the next slide, but it effectively moves your tax rate from about 30% to 9%. And along with your corporate return, you may also be required to prepare financial statements in prescribed form, such as those that you're required to submit with your tax return, give to other shareholders, or possibly give to your bank in support of your financing. It is this extra tax return and these financial statements and the requirement for you to have these prepared, which is a legal requirement, that is going to bring your bill for professional services up a little higher, as this information is not required if you are self-employed. And in order to prepare your tax return and other financial and related information, your accountant is going to require that you keep detailed financial records. As a corporation, and this is the side that fixes. You do have more stringent requirements for bookkeeping, which means that you're going to be asked to keep much better records. And I know that what everyone is interested in today is how you're going to pay yourself, which is the last big distinction that I'm going to go through for a sole proprietor versus a corporation. When you're self-employed, from a tax standpoint, the CRA is going to take the position that every dollar that you earn in the business, once expenses are covered, goes right into the business owner's pocket. So whether you transfer $1 of income earned out of that business into your personal account or 100, at the end of the day, you're going to be in the exact same position for taxes owing. As a corporation, 100% of the income earned in that corporation after expenses is paid is only taxed in the corporation at that reduced 9% rate. From this tax paid income, you then get to choose how much you want to pay yourself. As a shareholder, you're going to have three main options for remuneration to take that money out. If you're active in the business, which you would be as a real estate agent, you can pay yourself a salary and operate as an employee. In this situation, you would be responsible for withholding payroll taxes, and you may also need to withhold CPP and EI, dependent on your personal choices and structure of your business. As a shareholder, you can also pay yourself dividends. In this situation, you would transfer out exactly the amount of money you wish to receive, and the corporation would issue you, as the recipient, a T5 for dividend income. This income would then be included at a grossed up amount on your personal tax return, for which you may be required to pay some personal income tax. If the amount of taxes owing on this dividend income is greater than $3,000, you may be required to pay this tax to the CRA throughout the year as installments, as opposed to the normal personal tax deadline of April 30th. And then we have everyone's personal favorite, which is the shareholder's loan. As a shareholder in a corporation, every dollar that you put in can be taken back out on a tax-free basis, commonly referred to as the shareholder's loan. This is normally created when the shareholder starts the corporation and puts some money into the bank account to cover those startup expenses. And the loan is extinguished once the full value has been paid back. However, as a shareholder, you can be putting in money to the corporation at any time, which means your shareholder's loan can constantly be in a state of flux. To fully understand the financial difference between being self-employed and incorporated, I've set up a quick example for us to go through. So I'd like to introduce you to Sam. He is a real estate agent who is single and lives in the province of Example. We're going to assume that Sam's corporation is eligible for the small business deduction, so that great 9% rate, which makes incorporation financially viable. And as a corporation, Sam is going to need his corporate tax return prepared, and he's going to incur some additional legal fees to keep him on side. Well, the prices for these engagements are going to vary based on what you actually need done. We're going to estimate, for the sake of our example, that this is going to run you about $2,000 a year. And lastly, we're going to assume that Sam's registered for GST, but that any amounts owing have already been included in his $15,000 of expenses. So how is this going to look for Sam? If he earns real estate commissions of $50,000 with $15,000 of business expenses, right off the bat, your eyes are going to be drawn to the middle of the page where we say total cost. As a sole proprietor, Sam's total cost to file his taxes is going to be about $6,800. If Sam were to file that exact same return as a corporation, and even included in there that those extra professional fees he has to pay, you're going to see that he's going to be in a better position with his total cost being closer to $5,000. However, I'd also like to draw your attention to a second area on the screen, which is the bottom of the first column, where we talk about how much income Sam is going to have left after he pays out those mandatory expenses. And one of the first things that you will learn as a business owner is that income does not always equal cash. This is primarily due to the fact that some of your expenses may not match what has actually happened in your bank statement. So for example, let's take a look at meals and entertainment. When you go out to eat and you expense that meal through your business, you're going to be out of pocket $10 for lunch. However, when we prepare your tax return, we're only going to be able to deduct $5. So although you're going to show that you have deducted $5 from your income for tax purposes, your bank account is going to go down by $10, meaning that your net income is going to be a little bit higher than the cash that you actually have in the bank. This is an important distinction because you'll see in this example that after paying all of his business expenses, Sam only has $28,000 of income left in his business, which he can use to cover his personal needs, which means he may not even have $28,000 of cash. As a corporation, even with the additional expenses, Sam will have about $2,000 more left in that net income bucket, which means he should probably also have a couple $1,000s more of cash left from which he can pay himself. So if Sam were to decide that he's going to take out $30,000 of dividends, it's going to cost him $392 of personal tax when he files his personal income tax return. So all in, Sam is still going to be in a far better position than if he were operating as a self-employed individual. So that's great, but now I'd like to show you what happens as Sam starts to make a little bit more money. And the first thing that everyone is going to say to me is, Meaghan, I need to take out a lot more than $30,000 a year in order to operate. I've stuck with that number just to keep our math simple here today. Right away, you're going to see that Sam's cost as a sole proprietor is going to skyrocket, and now he's going to owe $15,000 in taxes. If he were to only take out that $30,000, he'd have a total tax cost for those income taxes and professional fees of $7,200 and still only be paying an additional $392 on his personal return for that money. If Sam were to say, hey, I've got more money and I'm going to take out $52,000 as dividends this year, it would cost him about $4,500 on his personal tax return to take that money out. This is still only going to bring him to a total cost of just shy of $12,000, leaving him still in a much better position than if he'd chosen to operate as a sole proprietor. So now the question remains, you've seen the dollars and you've seen that you're going to pay less taxes. So why shouldn't you go ahead and incorporate? Well, there's a few other things that I want you to think about today. At the end of the day, what are the financial costs going to be related to being a corporation? Although there are registrations that can complete your incorporation for you for cheap, we're always going to recommend that you use a lawyer for this process. And on average, you can expect to pay about $1,000 for this. You're also going to need to budget a couple $1,000s for closing costs if and when you choose to wind up or sell your corporation. And there's going to be some increased annual cost related to professional fees. You're also going to want to look at the profitability of your business. Often clients come to us because they've had a banner year. Their income's higher than normal and they've got a huge tax bill. Well, that is one reason why you might want to incorporate. We also recommend that you look at your average annual income when making this decision. Even if this isn't a great year, if on average your income is at a point where it makes sense to incorporate, you might want to go ahead and do that. You also want to look at how much money you plan to take out of your business on a yearly basis. If you're regularly going to be taking every penny that you earned out of the business, it may still make sense to incorporate, especially if your business is growing. However, as we did see in our example, the best tax savings occur when you're leaving some of that money behind in the corporation. Are you concerned about losing your ability to grow your RSP? Once you start taking dividends as opposed to taking a salary, your RSP room is no longer going to grow, although you will be able to use up any RSP room that you have previously accumulated and not yet used. And in a similar fashion, self-employed individuals are going to need to make both the employee-employer portion of their CPP contributions. In our example, you saw that when Sam took out $30,000, he had to earn $50,000. As a self-employed individual, that left him with a CPP bill of about $3,000 payable on his personal tax return, which didn't exist in his corporate return. And we also recommend that you take a good look at your 5-year plan before incorporating. I know that as real estate agents, you have seen some of the hurdles that your clients have to jump through in order to get a mortgage. Sometimes it's easier to qualify for your mortgage being self-employed, and sometimes it's easier if you incorporate and get your mortgage afterwards. And if you're planning on stepping away from your active business for a period of time, then you definitely want to talk with someone before incorporating, as it may not be financially worth it to do it. And the last thing that I like to tell everyone to look at, do you like to keep receipts? As a corporation, you may be able to take advantage of per diem rates, which are not available to self-employed individuals, such as you no longer have to keep your gas receipts because we can refund you all those vehicle expenses on a per kilometer basis. Well, now that you've heard me say way too much information on incorporation before you've probably had your morning coffee, I wanted to say thank you for joining us today, as well as open up the floor for you to ask any questions that you may have. I've left my contact information here if you would like to get in contact with me after the presentation to ask any personal questions, and I can also throw it up in the Q&A box if anyone needs it. And I'll throw it back to you, Alex.
Yeah, thanks so much, Meaghan. I'm going to just leave this slide up here. I'm not going to take off your screen share just yet, so more people have the ability just to see it and digest your contact information. I have a question for you. So, and it's from our chat. Someone is now looking at getting into the real estate business, so they have no previous income to base their decision off of. They have kind of their projections. What are the steps you would take them through to make the decision whether sole prop or a corporation would make sense for them?
Okay. So right from day one, we're going to talk about their 5-year plan and how active of a real estate agent they want to be. If they're looking at entering the market slowly, perhaps starting off as part-time, which I've heard before, I would suggest that let's start with sole prop. Let's see how things go. Let's make some clients. But we're also going to stay in contact throughout this whole first year. You can choose to incorporate at any time. If on Monday you're a sole proprietor, on Tuesday, you can be operating as a corporation if suddenly you've got some big sales coming through and you want to lock down those reduced tax rates before that income actually shows up. So we would be so to summarize, we'd be having a big discussion, and usually I'd be telling you, let's start off as self-employed, but we're going to put you right away with a stringent bookkeeping plan to stay on top of things. We're going to have regular touch points, perhaps every month, every 3 months, how things are going. And you're going to watch that income. As soon as you start getting close to a gross income of about $30,000, we're going to start reaching out to a lawyer to get things moved over to your corporation.
Okay, I'm going to take away the screen share because I actually want to see your face now when we're talking about this. So let me just exit that. Yeah, so now we actually can see each other again. Another great question that came up is, what do you recommend? Real estate agents or realtors or associates love real estate. So they love buying real estate. Now, I know there's going to be a lot more than a simple answer here, but in very generic terms, what makes the most sense for a real estate agent when they're looking at buying a rental or investment property for themselves through their corporation or in their personal name? And I'm guessing it depends on how they get paid as well.
A little bit how you get paid. Now, one question I will throw it out to any lawyers out there. I doubt we have any watching today, but you always want to check with if you're buying a rental property or an investment property or doing anything else in your corporation, double check those articles of incorporation, double check with your lawyer that you don't have anything in there that is going to limit your ability to do other things in your corporation. So assuming your corporation has been set up so that you can put your investment property in there, that is one option that you may want to put your investment property into your corporation. Now, anytime you're having and earning rental income, that's going to be paid out to you differently. It's considered investment income, which is treated a little differently than active business income, which is what you're going to be earning as a real estate agent. So as a real estate agent, your commissions are active business income. That's when you get to take advantage of that awesome 9% combined rate if you're a small business. Your rental income is still going to be stuck closer to that 30% rate. So whether you put it on your personal return or in your corporation, there usually isn't much of a difference. However, you may be able to take advantage of some better deductions if you have that in your corporation. And I know that there are real estate agents who love to grow their real estate holdings corporation and have a couple rental properties because you guys get first dibs on great properties coming to market. So if you are looking at putting a few properties into that portfolio, it may make sense to set up a real estate holding corporation right off the bat that you can put those into, because we may be able to take advantage of other tax planning methods, such as putting some financial investments or stock options in there as well, in order to defer some of those taxes you are paying and play around with things.
But simple answer, come talk to you before making any of those decisions.
Yes. Simple answer, come talk to us. Usually that first property can easily sit on your personal tax return. That second property, big discussions.
Right. Okay. Sounds good. And obviously it depends on the lender and their ability and what they're preferring to lend to and how you can show your income for affordability. But that's a different topic for a different day. So,
and the rate you can get on that mortgage could be better in the corporation, could be better personally.
Right. Right. Yeah. So talk to your professionals. That's that's the important thing. Meaghan, I'm going to get you just to throw your contact info back up on the screen one last time, just as we say goodbye, because that is all of our time for today. So yes, this is how you can get a hold of Meaghan. So if you have any questions, please do reach out to her, whether through email or giving her office a call. And Meaghan, thank you so much for participating with us today. It was great learning and we really appreciate it.
Thank you so much everyone for joining us. And thank you, Alex, for having me.
You guys.